Hi there. I'm creating this new video about why I prefer technical analysis over fundamental analysis. I made this shorter so that it's more accessible to many. But if you want the fuller discussion about this topic, I suggest you watch my earlier video about this because it's more comprehensive, and it's slightly longer, but it discusses more of the topic. So let's go on. Why I prefer technical analysis over fundamental analysis? Well, first, there is less guesswork. You might think this is weird because a lot of people consider fundamental analysis to be more academic and more structured, more regimental compared to TA. So you would think that no, it's TA that has more guesswork, but actually, TA has less guesswork than fundamental analysis. Why is that? Because TA depends on market action, which is mainly price and volume in the case of stocks, and open interest in the case of futures. But mostly it's price and volume. And there's not so much guesswork there because once a price is printed on the ticker tape or on the chart, well, there's no guesswork. Something happened at that price level. There was a transaction at that level. That's why it got printed. So there's no guesswork there. And then you see patterns. Technical analysis looks at patterns and trends, and there's no guesswork there because you're seeing it trending. You see it trending. You're seeing it going higher and higher, or lower and lower, depends. So you see the trend. There's no guesswork over there. What little amount of guesswork there is, well, there is some guesswork in TA because in any form of forecasting, there will always be a measure, some guesswork involved. But in the case of technical analysis, it is reduced to a minimum. What I mean is that, so I already mentioned that there's no guesswork regarding price and trends because it's there in the chart. You can see it. There's no guessing. What little guesswork there is that technical analysts would say that, okay, it is trending up. It is in an uptrend, so it is most likely to continue that trend. Some would say that part there is guesswork. You're guessing that it would continue, right? Well, that's true. It's you know you can't be sure. That's just an assumption. But that is just mainly that is just the that is there's just those are that's just one of the very few assumptions in technical analysis that the trend will continue. But even that so-called guesswork is not so much of a guesswork because it had been proven in the past that trends usually continue. They normally once it starts to trend, they normally continue the trend. So even that projection, that assumption is not very much of a guesswork. Compare this with fundamental analysis. In fundamental analysis, uh, you you assume, let's say, you look at past data about a company's earnings and you see that it is rising 10%, say, um, quarter on quarter or month on month, say, and then you make a projection that it's going that way in the next quarter, maybe in the next 2 quarters. So that's also an assumption. But unlike assuming that the trend will continue, this assumption is based on shaky ground because your basis for that assumption is based on other assumptions, on based on other a lot more assumptions. Like for example, you're assuming that the customers would continue to like the product of the company. You are assuming that the competitors will not introduce a new and better product in that time period. You're assuming that foreign exchange will not change very much. That would affect the operation of the company. You assume there's a lot of assumption in order for you to assume that the earnings trend or the revenue trend would continue. So that is more guesswork than what technical analysts do. And another thing is that not only are you assuming the trend of the um, earnings of the company revenues, you're assuming about the surrounding circumstances of the company. Like for example, that the political climate won't change, no new legislation would affect the company. So there are a lot of things that your assumption is based on, and that if those assumptions change, then the assumption it is based that the assumption based on it would also um, move way off target. So for that reason, there is more guesswork in FA, and I prefer TA. Next is that TA is more reliable than FA. So why is that? How is TA more reliable than FA? Well, first, TA relies mainly on price and volume, and those things are reliable, right? Because, like I said, if it's printed on the chart or in the ticker, then it happened, right? So you can rely on it. If a price moves to 100, then there was a transaction that happened at that level. It just won't go up to 100 without anything happening that made it go there. So if the ticker prints 50, then 50. Bought up at 50, bought down at 50, bought up at 51, bought down at 50. You can see that it happened. Okay, but in the case of fundamental analysis, fundamental analysts rely on financial statements, and um, while most companies are honest, there are some that are not that not holding to that ideal very well. Besides, even even if the company is not trying to do something out of line, even if they don't try to do something out of even just even if in the ordinary course of business, there's still some variation in how things are represented in the financial sheet. For example, um, um, how do they evaluate their goodwill? So there's some subjectivity there. So they might make it okay. Let's say goodwill. I'll put it in balance sheet. I'll put it as worth $500,000 or 2 million, like that. So there is those kinds of uncertainty. And for example, assets like company logo, company, the patents they owned. So how do they evaluate that? So other companies might evaluate it differently. They would evaluate it differently. There's those kinds of variations in the way things are recorded in the financial statement. So it's really hard. And if there are some companies who would intend to make their company look better than they really are, then there are things that they could do, and some of those things might not be very, might be a bit unsavory. And if you watch the news, you could see SEC or other government agencies go after companies like that. So that makes you question, how can you really rely on financial statements? It is supposed to be reliable, but humans being humans, so like that, right? And especially when you go to other territories, other stock markets, where you are not very familiar with their reporting regulations, their accounting rules, and things like that. Not every place is as strict as America, so you know, it's very difficult to just blindly rely on financial statements, right? But in the case of technical analysis, in the case of price, well, it's price. There might be some would say that, well, there are also market manipulations in the stock market, and yeah, but if they do that, they're still going to spend money, right, to buy or sell stocks. They're still, and it would still show in the chart that there's some irregularity in the buying and selling, and a sharp technician could observe that. They could notice that, so it's they're not as much affected by things like those compared to fundamental analysts, where the fundamental analysts, just by looking at the chart on the face of it, they just can't determine the reliability. But in the case of a chart, you can see um, irregular buying and selling, irregular volumes. You can see the pattern, and there's oh, there must be something fishy going on here, like that. So that I will also discuss this further in later in when I talk about TA's resistance to market manipulation. But for now, I would say that because of what was just discussed, I would say that TA is more reliable than FA, mainly because of the things that they rely on. The things that TA rely on are more reliable than the things FAs rely on. Okay. So the next here is that TA is more accessible. That is true because for in the case of FA again, FA fundamental analysts would want to determine the intrinsic value of a stock or a commodity or a currency, right? That's how they work, because once they determine the intrinsic value, that's how they would determine whether to buy or sell something. They would compare the intrinsic value with the current market value. So the first thing they do is to determine the intrinsic value. The problem with that is that you can't determine the intrinsic value easily. There are a lot of things that you need to know, you need to do, so that you will know the intrinsic value. You have to know the economic circumstances. You have to know company fundamentals, their balance sheet. You have to know these things. It's not so easy. It's not so accessible. You have to know accounting. You have to know finance. And in the case of multinational companies, you have to know a lot more things, like the economy of the countries they operate in, the political climate, the competition, what competition they have. You have to know these things. You have to know marketing, competition, in order to determine if the company is doing well, if they have a good intrinsic value. Because if you don't know those things, how can you accurately know a stock's or a company's intrinsic value? You have to know a lot of things. So it's not very accessible, because not a lot of people have degrees in accounting, in finance, in economics. So you just can't know all these things. And if you can't know all these things, then you can't properly determine the intrinsic value of something. And if you can't properly determine the intrinsic value of something, then your fundamental analysis is flawed. Right. In the case of technical analysis, again, it is just based on price movement, volume, and open interest. In the case of futures, and things like those, just it's based on a smaller set of stuff, and they are accessible, they are available, they are everywhere. They're everywhere. So makes TA more accessible. So next is this is what I said before. It is a resistance from insider trading, because while we hope that these things don't happen, and they don't happen often, I think, but maybe you would agree with me that they do happen. And if you look at the news, then you would see SEC and other government agencies go after some companies that that do this thing. So you'd know that these things happen, right? So if this would happen, if this would happen, TA is more resistant to it than FA because TA relies on price movement, price action, and mo- market manipulation, insider trading would show on the chart because there would be an anomalous transaction, either buy or a sell that is weird based on the pattern. So so the chartist could see that, a sharp chartist could see that. But in the fundamental and analysis side, the fundamental analyst relies on quarterly statements, and things like those won't show there, right? So so they would be more uh, prone to be affected by things like those. Okay, next here is that TA can be used alone without FA. Okay, the reason is that fundamental analysis mainly determines whether something is good to buy or sell. They determine the intrinsic value, and if it is lower than market value, then it is expensive, so they won't buy. And if the market value is lower than intrinsic value, then they would buy the security or the commodity. So like that. So they would buy, but when would they buy? Now, tomorrow? The timing is not very clear in fundamental analysis. So some fundamental analysts would still use a chart. If they won't, then that's not. Then their entry might be imprecise, and and I will discuss later the importance of precision of entry in later shortly, because that would be very important also. So so that's it for FA. In the case of technical analysis, you don't really need much fundamental analysis because price discounts everything, and if price moves, then you know the fundamentals are reflected in the prices. If the fundamentals are good, prices will move up. If fundamentals are bad, prices will move down. So you can see it there in the price. There's no need to go to fundamental analysis in order to make a decision. From the chart, you can determine if it's going down, so I'm not going to buy it, or I might short it. If it's going up, then I might buy it, right? So there's no need for FA anymore. Okay, TA is enough. And as for timing, then TA is great with that. They can see it is let's say consolidating breakout. Okay, that's where I enter, or it forms a double top reversal. That's where I enter. So as to whether to buy or sell, TA is good. As to when to buy or sell, TA is excellent. Very good also with that. So there's no need to rely on anything else. TA is enough, and that's why I one of the reasons why I really like it. FA is good, but you still need to use some technical analysis if you want your entry to be precise, which I will discuss later. Why you want your entry to be precise. Okay, so let's move on to the next. Another reason why I really prefer TA over FA is that it has broader applicability. Well, what does this mean? I mean, its applicability is not limited to one industry or one instrument. Um, I can use TA for trading stocks, for trading forex, for trading crypto, for trading commodities, options, futures, like that. And it's not the same with fundamental analysis. Fundamental analysis is very specialized because, again, you have to know a lot of things to determine intrinsic value, and you can just know a lot of little, right? What I mean is that you can just know a lot of, let's say, stocks, or a lot of, let's say, currencies. You can't know a lot of a lot. That's so much to take in, right? So normally fundamental analysts would focus on an area like stocks. In fact, it's not only that, they focus even more narrow than that. Like, for example, just industrial stocks, or tech stocks, or health, healthcare stocks, or tourism. They focus on that because there is a lot to know, a lot to learn, a lot to determine, to research, and you just can't do that for everything. You just don't have the time, and most don't have that energy. So they just focus on a narrow area. And some stocks, some industries or sectors operate very differently from others, even if they're both stocks, right? Um, let's say tech stocks, the movement of their industry is very much different from the energy sector, for instance. How the competitors of companies in the tech stock, in the tech industry, how they operate, how they affect the stocks, is very different than from say the energy. So if you want to do fundamental analysis, you have to know all these things, how they evaluate, even the valuation of companies. I just recently learned that, they value, let's say, social media companies by the number of users because of the network law, right? The more users, the more valuable a network is. So um, it's not you don't do that kind of valuation in other sectors. You don't do that in let's say in energy or in industrials, right? You don't value it like that. So they have a different valuation there in the tech sector. So you have to know those things. You can't know everything. Let's say for instance, you want to trade coffee beans. Um, if you trade coffee beans, you have to be concerned about weathers, about seasonal changes, about harvest season, about storms. You have to study those things. Um, those things are not necessary in other commodities, even if just within the same commodities. Each commodity requires different studies, different factors to consider, different parameters. So uh, um, a trader of, let's say, oil cannot easily just jump over to trading coffee beans, because there are things he needs to know to trade coffee beans, things he need to know uh, that he don't know, because those things are not required in trading oil. So that's it. So that's why it's not as broad as technical analysis. In the case of technical analysis, well, you rely on price and volume, or maybe open interest, and then it's the same regardless of what market you trade. Forex, it would be the same. Double tap in Forex, the same double tap in stocks. Cup with handle, it is the same. The psychology of the cup with handle, the psychology of um, a trend line break, the psychology of a resistance or support break, it's the same. Whether you trade commodities, currencies, cryptocurrencies, stocks, what have you, it's the same. So the applicability of TA is broader. And why is this important? Because you might say that, well, yeah, but okay, I agree with that, but I don't have to jump from one instrument to another. I don't have to jump from one sector to another. But sometimes you have to, because of the reality of the markets. Markets are cyclical. Sometimes industrials are in an uptrend, and there would be a time when they just move sideways, and you can't either go long or short. So what you do, you stick in the sidelines. But if you can move to a different uh, market, then it would be great, right? Because you can find a different market that is trending, whether up or down, and then you can have a short or long position in that market while industrials are doing sideways. So your money won't be sitting doing nothing, right? So that's the benefit of being able to having the flexibility to jump from market to market. It will enable you to make use of your time, to make use of your resources when the current market is not doing anything. It is very painful to sit on the sideline looking at other markets that are trending, but you just can't hop over there because you're a fundamental analyst and you are not familiar or trained or skilled to do fundamental analysis on that instrument, on that security or commodity. So for TAs, it doesn't matter. It's the same. So they are, let's say, in currencies, and then, oh, it's very volatile this because of some political situation, so it's very dangerous. I'm going to move to stocks. Okay, so which stocks, which sector industry is trending? So okay, I'll go there. They can do that. I'll go to commodities because it seems like gold is on the rise these days. So they do that. They go there. They just look for a dip. They buy the dip, and then they ride the trend. So that's it. There's no need to, oh, gold. So what affects the price of gold? What are the fundamental parameters that I need to know? No such things, right? So that's the importance of broader applicability, and why I prefer TA, because its applicability is broader than in FA. Then here we discuss about precision of entry and exits. I mentioned this a while ago, right? That TA is better because you don't need FA. FA, however, would need TA if they want precision. Why is precision important? Okay, um, precision is important because sometimes even when you are right on a trend's direction, let's say you predict that, let's say I'm doing fundamental analysis, okay, and then I determine the intrinsic value of something to be 100 and it's currently trading low. Market price is, say, 50. Then I would say, wow, it's cheap. And then I'd say that I'm going to buy this because it's a lower, the market value is lower than the intrinsic value, so I'm going to go in. So you do. um, but while it is true that it is indeed cheap, and that indeed after 2 months it goes up, but there's a possibility that in the meantime it might go down first. So if it goes down first, then you'd have a drawdown, right? um, it's not very important in the case of stocks. Well, you would say that no matter. I will just buy more when it goes down, and or I will just hold it until it goes up. Well, that's right. That's true. It's true. That's right. But in the case of other, that's another thing why TAE has a broader applicability because of things like this. Because this strategy that I just mentioned, buy and hold, this won't apply in forex, in futures, in cryptocurrencies, in crypto, and other highly leveraged markets. This won't apply. Why? Because in that case, let's say the same situation. I'll bring it to crypto. So let's say Bitcoin. Let's say you are right that Bitcoin would rise because, let's say, you know of a fundamental reason why that would be so. For instance, Tesla just said that it is going to adopt Bitcoin, or some other company, for instance, would use Bitcoin, and then you expect it to rise because of demand, because there's a fundamental reason for it. Let's say you are right, but you didn't use precision entry. Your entry was not precise, so you bought earlier than you should have. So while indeed it would rise in a few weeks, but if it goes down in the meantime, then you could, if it go, especially if it goes down uh, enough to earn your margin call, then your position could be closed at a loss because of margin requirements, because it is very highly leveraged. So your broker is going to close your position. You'd be closed, and then you'd end up at a loss, even if a few days after it did go up. So the problem was you entered early. Okay, so that's the importance of precision entries. You have to enter. You have not. You don't only have to be right as to the direction, but you also have to be right as to when to enter, because you could still lose even if you're right. And that's the hard thing. That's a very hard thing, because while it is painful to lose when you are wrong, it is so much painful to lose when you are right. Okay, so that's why um, precision of entry and exit is very important. As to the exit, imagine this. Imagine you are already gaining. You are already gaining. Okay, but your exit is not very precise. Okay, my exit will be somewhere around there, and then you're gaining. You're gaining, but you did not notice, because you're not a technical analyst, that is there's already a slowing of momentum. There's already a distribution, and then suddenly it fell down. It didn't reach your target, right? So you were right. You were right to say it would go up, but your exit was not precise. So your exit was later than when it should be. So the price now drops down to your entry, drops down below your entry. Now you're at a loss. So imagine that. You could have earned that, but you didn't. In fact, you earned a loss. So that's the importance of precision in entries and exits. So next is to take advantage of expert knowledge. Like I told you, in fundamental analysis, you need to know a lot of stuff in order to properly determine the intrinsic value. And to be really honest, it's hard for a person to know a lot of all those stuff on his own. That's why big funds have employ plenty of experts, because there are experts on oil, there are experts on foreign exchange, there are experts on economics and finance and investigative accounting, so that they can pool those expertise together and they can make better decisions, right? Um, so 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 since they have these big funds, these like insurance agencies, these mutual funds, hedge funds, banks, other big financial institutions, since they have this expertise, you can take advantage of this knowledge, because when those experts study the market, they study it for a reason, to make a decision whether to buy or sell, right? So now, once their pooled expertise, their pooled knowledge, their combined research um, reaches its conclusion, they would decide, okay, I will say buy this stock. Let's say I will buy Apple, okay? And when they do that, when they do buy Apple, then it's going to reflect on the chart. And then others with a whole department of experts would also determine the same thing, and they would buy Apple. And then here you are doing TA, sitting watching your chart. You'd see those massive buy orders. You'd see the sudden change in the movement of Apple stock. So you would notice, sharp charters would notice that, oh, the big guns are buying into Apple, so I'm going to buy into Apple too. So in a way, you took advantage of their expert knowledge. Not all of us technical analysts have a room, a department, an army of experts in a lot of fields, right? But we can take advantage of the movement, of the result of the studies, of the expertise of the bigger funds, the bigger players, because we can see it in the chart. So even if we don't have that muscle power like them, well, they have to move sometime, right? They just can't do some research, take let their experts do research and those things without doing anything. They have to do something, and we technical analysts would just wait for that something that they're going to do. And the moment they do that, then they're voting with their money, so we know it's reliable, so we ride that wave. So that's how we can take advantage, even if we don't have an army of experts somewhere in our backyards, right? And that's the problem with FA, especially if you are a lone trader doing FA. Most likely your FA is wrong, because you can never know as much as those people over there, as those big institutions. So you'll never, if you rely on FA, you are never going to beat those people because they employ a lot of experts and you can only know so much on your own. So if you are a part of a fund, then okay, do FA. But if you are a lone trader, if you are a lone investor, it's so hard if you don't have a bunch of experts because you cannot know everything there is to know, everything you need to know to properly determine intrinsic value. There are just a lot of factors that you can't consider. They can, and you can't. But technical analysts, well, they just follow the move. If the whale moves, well, they can't help but move the tide. So the technical analysts will just move with those tide. So there's it. There's this, guys. Sorry. I'm talking very fast here because I want to discuss a lot of things in a very short time, and this really is just a some kind of a speed intro as to why TA for me is way better than fundamental analysis. If you want a more comprehensive discussion about this topic, search the longer video about this in my channel. It's almost 2 hours, and I discuss a lot of things there that I have to cut short for this video because I don't want this to be long. But it's just sort of an intro for you guys to see if it's something you might be interested in. So there you go. And thanks for listening. And again, pardon for the very speed speaking. I don't normally speak like this. so, so if you want a more in-depth discussion, a more thorough discussion of this topic, go look for my other video on this. This is the shorter version. So thank you very much, and have a great day.